Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at MRR holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and today's topic is, it's honestly pretty wild.
Oh, it's completely wild. Like, imagine losing $1.8 billion in just 6 months.
Right, staggering.
And your only survival plan is to leap from, the most volatile asset in the world, crypto, straight into the most expensive infrastructure arms race in human history.
Artificial intelligence.
Exactly, AI. It's just a profound shift. We're looking at a company trying to completely rewrite its own DNA while the ground is, well, essentially crumbling beneath it.
It really is. And, before we really get into the weeds of these radical financial maneuvers and figure out if this massive AI pivot can actually save them from this crushing cash burn,
Right.
we should mention how we're actually tracking all this chaos. Because making sense of a turnaround this complex is, it's tough.
Oh, it's nearly impossible with just a traditional spreadsheet, which is why we use StockOracle. It's an AI-aided stock research platform.
Right.
And we actually have a special 14-day trial link for it right below in the description. Now, just a quick heads up, that is an affiliate link, so the channel may earn a commission if you use it, but at absolutely no extra cost to you.
Yeah, and we always have to be super clear here. StockOracle is amazing for organizing data, but it is not financial advice.
Definitely not.
It's not a trading signal service, and it's not real-time market data. The AI insights and those valuation estimates it spits out, they can be incomplete or just flat out wrong.
Yeah, you always have to verify the important facts yourself.
Exactly. And keep in mind, the data is usually delayed like 15 minutes for U.S. stocks or even end of day for OTC markets.
Right. It's a research assistant, not a crystal ball. But, okay, let's unpack this MRA situation, because to understand the promise of their future, we have to just stare directly at the financial reality of their present.
And it is a harsh reality.
Harsh is putting it mildly. I mean, they took a $1.874 billion net loss in the first half of 2026.
Hey.
Yeah. And just a year prior, same exact period, they actually turned a $274 million profit.
It's a massive swing.
So I need to understand the mechanism here. How does a publicly traded company hemorrhage almost $2 billion in, 26 weeks?
Well, you really have to look at the underlying mechanics of their legacy business model, right?
Nice.
Which is crypto mining.
Okay.
Stripped down to its absolute core, crypto mining is basically just an energy arbitrage business.
Energy arbitrage.
You are converting raw electricity and computing power into a digital asset, primarily Bitcoin.
Right.
But when we look at MRA's operational stress right now, their gross margins didn't just dip a little, they completely collapsed.
How bad?
Down to negative 61.76%.
Wait, hold on. Let me stop you there, because I really want to make sure I'm wrapping my head around that metric. A negative 61% gross margin, that essentially means that for every single dollar of revenue they bring in from mining, they're spending $1.61 just on the raw cost of running the actual machines.
That is a very accurate way to frame it. Yeah.
It's a business model running entirely backwards.
It is. The cost to mine a coin is vastly exceeding the market value of that same coin.
Man.
And, this happens when the underlying asset drops in price or when the mathematical difficulty of mining spikes, like we see after a Bitcoin halving event.
Right, the halving.
Or even just when local energy costs spike. But whatever the exact combination of those headwinds is, the result is that their daily operations are just aggressively destroying capital.
Destroying it. I saw their operating cash flow for the first half of the year was negative $471.2 million.
Exactly.
Yeah.
The business itself is just sucking all the oxygen out of the room.
Which I guess leads us to the most shocking data point we found, because to keep the lights on, MRA liquidated $1.6 billion worth of their Bitcoin treasury.
Yeah, that was over 23,000 Bitcoin sold off in just a matter of months.
23,000.
Yep. Their total assets plunged from $7.2 billion down to $4.3 billion.
I mean, when I read that, the only image that came to mind was a captain trapped in a severe storm, literally chopping up his own ship's mast to feed the steam engine just to keep moving.
That's a great analogy.
But I really have to push back on the strategy here, because the entire appeal of a pure play crypto miner for an investor is that massive treasury, right?
Usually, yes.
Investors buy the stock because it acts like this leveraged proxy for Bitcoin. If you just sell off your defining asset, aren't you just plugging holes in a sinking ship with pieces of your own hull?
I see why you draw that conclusion. It looks terrible on the surface. But it's actually a bit more complicated than just a desperate captain burning the furniture.
Okay, how so?
Well, the liquidation, while severe, is a symptom of a dual reality. Yes, they are sacrificing their main source of upside leverage, but you have to look at their balance sheet obligations.
The debt.
Right. MRA is carrying an enormous $2.4 billion in total long-term debt.
2.4 billion.
Yeah.
And with deeply negative cash flows, they have absolutely zero organic way to make the interest payments on that debt, let alone pay down the principal.
Precisely. You cannot service billions in debt with a negative operating cash flow. The creditors, they don't accept future potential. They require current liquidity.
You want cash today.
Right. Furthermore, MRA isn't just trying to survive the storm. They're trying to fundamentally transform the ship itself.
The pivot.
Yes. They're pivoting toward high-performance computing, or HPC, and AI infrastructure.
Right, becoming a data center.
Building next-generation data centers requires an astonishing amount of upfront capital. So that Bitcoin fire sale wasn't just about plugging holes. It was a forced, yet incredibly necessary strategic reallocation.
Just to buy their way into a completely different industry.
Exactly.
And that pivot is really the crux of this entire story, isn't it? MRA is basically betting the house on AI infrastructure.
Totally.
They're planning to expand a site down in Texas to a massive 1 gigawatt of capacity by 2027.
A full gigawatt.
Yeah, and they're developing another pending site. I think it's called the Long Ridge Project.
That's right.
They've even completely refreshed their board of directors. They brought in 2 new independent members, Craig Hart and Nancy Novak.
Who both specialize deeply in power and data centers, which is very telling.
Right. But help me bridge this gap for a second. Why is a crypto mining company suddenly trying to become a landlord for artificial intelligence?
Well, it comes down to the physical constraints of the current AI boom.
Okay.
The biggest bottleneck for training these massive large language models isn't just getting enough advanced silicon chips from companies like NVIDIA.
What is it then?
It's the power grid.
Ah, the electricity.
Yes. AI servers run incredibly hot. They require astronomical amounts of electricity, not just for the actual computations, but for the advanced liquid cooling systems required to keep the whole facility from melting down.
Wow.
Yeah. A 1 gigawatt site. That is the energy equivalent of powering hundreds of thousands of homes.
Okay, so because crypto miners already had to secure these massive industrial power contracts
Yes.
and build out heavy grid infrastructure in places like Texas, they are basically sitting on the exact real estate that AI companies are desperately looking for.
What's fascinating here is that the structural foundation is almost identical. Both require industrial-scale electricity, robust cooling, and extremely heavy data connections.
So migrating from hosting Bitcoin mining rigs to hosting AI servers is, well, on paper, a highly logical leap.
Exactly. MRA already has the raw ingredients.
On paper.
Right.
But let's look at the actual execution here, because building the infrastructure is great, but where are the paying tenants?
That is the multi-billion-dollar question.
Right, because while MRA is drawing up blueprints and pointing to 2027, their direct competitor, Riot Platforms, is kind of leaving them in the dust.
Yeah, Riot is moving very fast.
Riot reportedly just secured a mammoth $9.1 billion deal with Anthropic.
One of the premier AI developers on the planet.
And because of that signed contract, Riot is getting outperform ratings from analysts who see like 80% upside potential.
Right.
Meanwhile, MRA just reported a Q2 revenue miss. They brought in $174.9 million against expectations of $209.4 million.
It's a significant miss.
It really feels like MRA is building a luxury hotel in the desert and just hoping someone books a room.
Yeah, you're touching on the concept of competitive lag, and honestly, it is the most dangerous space for a company to occupy.
How so?
The market doesn't reward you for having the capacity to do something if your direct rival is already actually doing it. Riot validated the whole crypto to AI pivot by actually securing a mega contract. MRA is pouring massive amounts of capital into foundation work. I mean, that Texas expansion proves it, but without a committed paying anchor tenant.
The whole AI thesis is purely speculative.
Entirely speculative.
So if you're bleeding cash from your legacy business and your new business is just this incredibly expensive empty warehouse waiting for a tenant, how on earth is Wall Street pricing this reality?
Oh, brutally.
We have to look at the market reaction because the red flags aren't just waving, they're practically on fire.
Yeah, the technicals are really ugly.
Let's start there. MAR recently closed at $9.71. That is nearly 60% below its 52-week high of $23.45.
A massive haircut.
And it is trading below all of its major moving averages, the 20-day, the 50-day, and the 200-day simple moving averages.
Yep.
Now, I want to pause here for anyone who doesn't spend their days staring at stock charts. I'm looking at these moving averages, and it's just a sea of red. Help me understand why falling below all three of these specific lines is such a, death knell.
Sure. Think of a stock's daily price movements, like the waves on a beach, right? They're erratic, bouncing up and down every few minutes.
Okay.
Moving averages strip out all that daily noise to show you the actual tide. So the 20-day moving average shows you the short-term momentum from the past month.
Got it.
The 50-day shows the medium-term quarterly trend. And that 200-day moving average, that is widely considered the ultimate barometer for long-term health.
Okay, so what happens when a stock breaks below it?
When a stock is trading below its 200-day average, the institutional money generally views the asset as fundamentally broken.
Wow. So falling below all three means the sellers are in complete control, whether you're day trading it, swing trading it, or even holding it for retirement.
Exactly. The tide is rushing completely out.
And it's not just retail traders seeing this, right? The institutional analysts are highly skeptical too.
Very much so.
I mean, Morgan Stanley maintains an underweight rating on America.
Which is their polite corporate way of saying, avoid this stock.
Exactly. And they recently pinned a price target of $6 on it. Given it's trading near $10 right now, one of the biggest banks in the world is projecting massive further downside.
And they aren't the only ones who are pessimistic.
Right, which brings us to the thing that really stops me in my tracks out of all the data we looked at. The boardroom sentiment.
Yeah, the insider selling.
The insider sentiment score is at maximum bearishness, a literal score of -100.
You can't get lower than that?
We're seeing 7 recent open market sales by company insiders and 0 purchases. Not a single executive is buying the dip here.
No.
If the people steering the ship are quietly putting on life jackets and hopping into the lifeboats, why should the average retail investor stay on board?
That is the hardest metric for any bullish investor to reconcile. Now, we should be fair here. Insider selling doesn't automatically mean fraud or imminent collapse.
Right.
Executives often receive stock as a large part of their compensation, and they sell it to buy houses, pay taxes, or just diversify their personal wealth.
Of course, they have personal financial lives outside the company.
Exactly. But you have to look at the overall pattern. When you have 7 unmitigated insider sales, 0 insider purchases, a massive revenue miss, heavily negative cash flow, and a totally broken technical chart.
The context changes entirely.
It absolutely does. It suggests a profound lack of internal confidence that this AI pivot will yield any real results in the near future.
And layer that on top of recent sector-wide Bitcoin sell-offs, and MRA is just getting squeezed from every possible direction.
They really are.
Which brings up a really interesting challenge for you listening to this. If you are trying to evaluate a situation like this, a company losing $1.8 billion, liquidating its core assets, pivoting to a totally new industry, and suffering from massive insider flight, how do you actually model that?
You can't just pull up a traditional spreadsheet.
Right. Marare's price-to-earnings ratio doesn't even exist right now because their earnings are just a massive negative crater.
Traditional valuation methods break down completely when a company is in the middle of a chaotic metamorphosis like this.
Yeah.
And this is a major reason why we are seeing such a surge in platforms like StockOracle. Investors are trying to find tools that can synthesize moving targets.
Which is why we brought it up earlier. It's built specifically to handle this kind of data overload. I mean, they pull standardized data from heavy hitters like FactSet, and they track up to 468 different financial metrics across more than 15,700 U.S. and OTC securities.
It's an immense amount of data processing. But the value proposition isn't just having the data. It's the organization. Take a feature like OracleIQ, which builds these color-coded views of a company's financial pillars.
Oh, I love that feature.
Right. If you evaluate MAA through that lens, you don't have to spend hours digging through SEC filings to realize the cash flow and margin pillars are flashing bright neon red.
It instantly visualizes the structural decay.
Exactly.
But the tool that really caught my attention is OracleValue. It attempts to generate an intrinsic value estimate for the stock, meaning what the company is actually worth beneath the current market hype or panic.
Yes. And it's quite robust.
Yeah, it doesn't just use one simple formula. It uses 9 different established valuation models, including something called discounted cash flow.
Ah, the famous DCF model.
Now, explain discounted cash flow to me like I'm five. Because if a company is currently burning nearly $500 million in operating cash, how can you possibly value them based on cash flow?
Well, that is exactly where the friction lies. The premise of a discounted cash flow model is actually quite simple.
Mm.
A company is only worth the total amount of cash it will produce in the future, discounted back to what that cash is worth today.
Because a dollar tomorrow is worth less than a dollar today due to inflation and, like, opportunity costs.
Exactly right. So you project out their profits for the next 5 or 10 years and calculate the present value.
Okay.
But you hit the nail on the head earlier. How do you project the future cash flow of MARA? Their current cash flow is deeply, deeply negative.
Right.
To make a DCF model work for them right now, an AI platform has to make massive, highly speculative assumptions about exactly when that Texas facility will be finished, who the tenant will be, and how much that tenant will actually pay.
So it's just guessing at that point.
Essentially, yes. It's an educated projection, but still guess.
Which is why I look at these AI platforms like a high-tech GPS navigation system in your car.
That's a good way to put it.
Right. A great GPS is incredibly useful. It can show you the traffic jam on the highway, it can warn you about a speed trap, and it can suggest a detour, but it cannot physically drive the car for you.
No, it can't.
And if you blindly follow the screen and drive your car into a ditch on that detour, you can't blame the GPS.
That is the most crucial limitation investors need to grasp here. These platforms are brilliant research organizers, and features like AI mode analysis are great, but they are absolutely not financial advice.
Not at all.
When a company is radically pivoting like MRA, historical data is largely useless. You have to verify the facts independently, cross-reference the data, and make decisions based purely on your own risk tolerance.
It's really about letting the AI organize the noise so your human brain can actually analyze the music.
Beautifully said.
Thank you. Which brings us to the final verdict on MRA. Based on all the metrics, the financial wreckage, and the competitive landscape we've unpacked, the overall assessment for this stock on a 6 to 12-month horizon is deeply bearish.
Very bearish.
It currently sits at a rating 3 out of the available metrics.
The fundamentals simply do not support optimism right now. You just cannot overlook a $1.8 billion half-year loss.
No, you can't.
Or a complete breakdown in technical momentum and executives who are steadily selling their shares.
So I have to ask, is there any realistic path to redemption for them?
The path exists, but it is incredibly narrow and brutally steep.
Okay, what is it?
The entire turnaround thesis relies on executing two things flawlessly. First, they have to stop the bleeding. The $1.6 billion Bitcoin liquidation bought them time to manage their debt, but that well is now significantly drier.
Right, they can't do that again.
No. Second, and this is the absolute make-or-break moment, they must secure a massive multi-year AI infrastructure contract.
Like Riot did.
Exactly. If they announce tomorrow that a major AI player has signed a 10-year lease for their Texas gigawatt facility, the narrative flips on its head immediately.
But until that ink is actually dry on a contract.
MRA is just an expensive, highly speculative bet. Remember, we aren't telling anyone to buy, sell, or hold this stock. We're just looking at the mechanics.
Of course. And this whole situation is just an absolute masterclass in watching a company try to outrun its own balance sheet by leaping from one speculative boom to the next.
It really is.
For you listening, this is exactly why it pays to look under the hood. You can't just invest in the buzzwords a company puts in a press release. Everyone wants to be an AI infrastructure company today, just like everyone wanted to be a crypto company 3 years ago.
Yep, the hype cycle.
But the market eventually demands proof. It demands positive cash flow, manageable debt, and actual paying clients.
It's a harsh reminder that corporate survival often requires painful, seemingly contradictory sacrifices. Burning your core asset to buy a lottery ticket in a new industry might be their only option, but it certainly doesn't guarantee a winning ticket.
No, it doesn't. And before we head out, just a quick reminder that if you want to run these kinds of metrics yourself, the StockOracle 14-day trial link is down in the description.
Yep, check it out.
Which leaves us with a fascinating and, frankly, somewhat provocative question to mull over as we wrap up.
Oh, I'm curious.
Given the staggering capital requirements of this current artificial intelligence boom, I mean, the sheer cost of the industrial land, the gigawatt power contracts, the liquid cooling systems, are we witnessing the beginning of the end for the pure play Bitcoin miner?
Oh, wow. That is a big question.
Right. Will the relentless economic pressure of computing force all of these crypto mining operations to eventually abandon their original purpose and become AI data centers just to survive?
I mean, if the guaranteed recurring revenue of hosting AI servers continues to completely dwarf the highly unpredictable, volatile rewards of mining digital currency, this painful pivot we are watching MRI attempt might just become the mandatory blueprint for their entire industry.
A fascinating shift to keep an eye on as the collision between crypto and AI continues to unfold. Thanks for joining us on Smart Wealth with Joshua. Don't forget to subscribe, and we'll catch you next time.